Welcome back to Talk Tickers. This is the show where we strip down the earnings calls you didn't have time to listen to, and we rebuild them into the actionable intel you actually need.
We read the footnotes so you don't have to.
Exactly. It is Wednesday, January 21st, 2026. The market is open, the coffee is pouring, and frankly, if you're holding regional bank stocks this morning, you are probably refreshing your screen trying to figure out if you should be relieved or confused.
It is a fascinating morning for the sector.
Yeah.
We are seeing a massive amount of dispersion. The rising tide isn't lifting all boats today.
No.
Some are taking on water and, others are putting on speed. It is a stock picker's market out there right now.
And we are focusing on the speedboat. Today's deep dive is Metropolitan Bank Holding Corp, ticker M-CB. Let me just set the scene for you. Pre-market was buzzing. The stock is currently trading up significantly, flirting with that $90 handle. We're talking fresh 52-week highs.
And to be clear, MCB is aggressively outperforming the regional banking proxy, the KRE. While the broader sector is struggling to find direction, MCB is charting its own course. If you look at the last month, the sector is essentially flat, maybe up 3%. MCB is climbing a vertical wall.
This is the hook for me. We have spent the last 18 months hearing the same narrative. Regional banks are terrified. They're terrified of the shadow of commercial real estate. They're terrified of shrinking margins.
And they're terrified of their depositors leaving.
Right. Then MCB walks in this morning and delivers what I'm calling a proof of model quarter.
It feels like a vindication of their strategy, doesn't it?
It does. They aren't just surviving, they are expanding margins. But before we break out the champagne, we need to scrutinize the numbers. Because on the surface, this looks like a massive beat. Almost too massive.
It was a very clean print, generally speaking. But let's look at the headline. GAAP earnings per share came in at $2.77.
Just to pause there, GAAP is the generally accepted accounting principles number, the official scorecard, 277.
Right. And to put that in perspective, the consensus estimate on the street was sitting at $2.07. That is a 70-cent beat.
70 cents?
I mean, in the world of boring bank earnings, missing or beating by a nickel is standard deviation. Beating by 70 cents, that is a statement. That is a loud statement.
Revenue followed suit, $88.41 million, beating the street by over $5 million. That's up nearly 25% year over year. But I know you're looking at that $2.77 EPS number, and you represent the skeptical listener. Was this all organic growth, or was there some, accounting magic in there?
Because 70 cents is a lot of room for one-time tricks.
It's a lot.
I hate to be the wet blanket at the party, but yes, we have to look at the quality of earnings. If you dig into the press release, management was transparent. There was some noise. They had about 30 cents per share of what we call non-core helpers.
Okay, break that down. Is this we sold a building money, or is this we found change in the couch money?
It's a mix of things. They had elevated prepayment penalties, basically borrowers paying off loans early, which triggers a fee. That added about $1.7 million to income.
Okay.
They also sold some bonds for a gain of nearly $700,000, and they had an insurance recovery and a compensation adjustments. All told, that's about $4.6 million, or 30 cents a share.
Okay, so let's be fair and do the math. You take the 277 headline, you strip out the 30 cents of noise, and you're still at $2.47.
Which is still 40 cents above the consensus estimate of 207.
Right.
So even if you strip out every single one-time benefit, this was a massive core earnings beat. The engine is running hot. You can't fake a 40-cent core beat.
And the fuel for that engine, and this is my favorite part of the print, is the net interest margin, or NIM. For the listener who doesn't live in a bank spreadsheet, can you give us the quick sort of explain it like I'm five on why NIM matters so much?
Sure. Net interest margin is basically the bank's gross profit margin. It's the difference between what they pay you for your deposits, which is usually low, and what they charge borrower for a loan, which is high.
And everyone's is getting squeezed.
Exactly. In a world where every other bank CFO is crying about margin compression because deposit costs are going up, MCB is posting a 4.10% NIM.
4.1%. That feels incredibly high for a regional bank in 2026.
It is the star of the show. It expanded 22 basis points from the previous quarter. That is incredibly rare right now.
Wow.
Most banks are seeing their cost of funds rise faster than their loan yields, squeezing that margin. MCB is doing the opposite. They are widening the gap between what they pay and what they earn.
So how are they doing it? Because that brings us to our deep dive on the financials and strategy. It seems like the secret sauce here is the deposit engine.
It is. If you want to understand why this stock is at $90, you have to look at the liability side of the balance sheet. Deposits grew by $1.4 billion for the full year of 2025. That's a 23% increase.
And just in Q4, they were up over 4%. But it's not just that they have more money, it's where it's coming from, right?
Exactly. This is the critical piece of context. They funded all of their loan growth with these deposits. They didn't have to go out and borrow expensive money. You often see banks using wholesale funding.
Right, from the Federal Home Loan Bank.
Or brokered CDs just to keep the lights on. That money is expensive and it eats your profits. MCB actually paid off $450 million in that expensive wholesale funding during the year.
That is the holy grail. Replacing expensive debt with cheaper client cash. It's like paying off your high-interest credit card with a low-interest loan from a friend.
And it gets better. Their cost of funds is actually dropping. Interest-bearing deposit costs declined by 43 basis points in the quarter. Management noted that their deposit beta on the way down is about 75%.
Okay, deposit beta. That sounds like something from a physics lecture. Translate that for us, because I see that term thrown around in every analyst note today.
It's simpler than it sounds. Deposit beta just measures how sensitive the bank's deposit costs are to the Fed's interest rate changes. A 75% beta means that is for every 1% the Fed cuts rates, MCB drops the interest rate they pay depositors by 0.75%.
Got it.
They capture 75% of that rate cut as pure savings.
So as the Fed cuts, MCB's costs plummet, but their loan yields stay high.
Precisely. They are asset sensitive in a way that benefits them significantly here. They have $1 billion of hedged index deposits. So as rates fall, their interest expense falls faster than their interest income. That protects that 4.1% margin we talked about.
They've essentially built a fortress around their profitability.
They really have.
Okay, so they're flush with cash. What are they doing with it? Let's talk about the lending side. You mentioned loan growth was flat in Q4, which sounds bad on the surface. If I see zero growth, I usually assume the business has stalled.
It looks bad if you only read the headline, but context is key. It was flat because of those prepayments we mentioned earlier. They had $317 million in loans pay off.
It's a lot of churn.
It is. But the originations, the new loans they're putting on the books, are coming in at incredibly attractive rates.
I saw that stat. The weighted average coupon, or WAC, on new volume is north of 7.2%.
That is a huge spread. I mean, think about the math. You're bringing in deposits at 3 or 3.5%, and you're lending them out at 7.2%. You're effectively printing money on the spread.
And that's how you get to an efficiency ratio of 50%.
Exactly. For every dollar of revenue, they only spend 50 cents to run the bank. That is incredibly lean. Most regionals struggle to stay under 60%.
It's top tier. I'm looking forward.
They're guiding for about $800 million in loan growth for 2026. That's roughly 12% growth. They aren't staying flat. They are just reloading the cannon.
And the CFO made a very specific promise about that growth.
Yes, he said, we expect to fund all planned loan growth with deposits. That statement alone removes a huge overhang for investors who worry about liquidity. They don't need to go begging for cash. They're self-funding.
Let's shift gears to the where, because this isn't just a New York story anymore. They're making a very specific geographic play that feels opportunistic.
They're following the wealth. We've seen this massive migration of capital from the Northeast to the South, specifically Florida. MCB isn't fighting that trend. They are surfing it.
They opened a branch in Lakewood, New Jersey in Q4, but the real story is 2026.
Miami and West Palm Beach. They're opening 2 branches there in the first half of 2026. This isn't just throwing a dart at a map. They're chasing their existing client base that has moved south.
It feels like a very deliberate snowbird strategy. You bank them in New York when they're making their money, and you bank them in Florida when they're spending it.
And more importantly, you capture the lending opportunities in Florida, which is a high-demand market, using the cheap deposits you gathered in New York. That is the arbitrage.
Now, usually when a bank enters a new market like Florida, they just buy a smaller local bank. It's faster, it's easier. But CEO Mark DeFazio, he shut that down fast.
He was very explicit, no M&A. He basically said, We don't see value in the franchises out there. And honestly, investors love hearing that right now.
Oh, yeah.
Mergers carry integration risk. They carry balance sheet risk. DeFazio is saying, our model works. We don't need to buy someone else's problems.
No team lift-outs either, where you pay a premium to hire a whole lending team. It's purely organic growth. But they're spending money on something else. We have to talk about Project Modern Banking in motion.
Catchy name, isn't it?
It sounds like a marketing slogan from 1995, but apparently it's a big deal for their infrastructure.
It is critical. They're doing a full digital core conversion scheduled for President's Day weekend coming up in February 2026.
The dreaded bank holiday weekend conversion. I have friends in IT who have PTSD from these. It's basically 48 hours of pure terror, hoping the servers come back on.
It is always a nail biter. If it goes wrong, customers can't log in, balances look wrong. It's a nightmare. It is costing them about $3 million in Q1 expenses.
Right.
But the argument is that this sets the stage for scale.
Right.
If you want to grow deposits by 20% a year without opening 50 physical branches, you need a top-tier digital platform. This is them paying the toll.
So we have growth, we have margins, we have a digital upgrade, but we have to address the elephant in the room. We cannot talk about a regional bank in 2026 without looking at the credit quality. And there was a number in there that might have made some people flinch.
You're looking at the non-performing loans, the NPLs.
Yeah. NPLs to total loans ticked up to 1.28%. A year ago, that was 0.54%. That's a doubling. In this environment, with all the headlines about commercial real estate, shouldn't investors be panicking about that uptick? Doubling bad loans is usually a fire alarm.
Panic is too strong a word, but scrutinize. Absolutely. A doubling of bad loans is never something to wave away.
Yeah.
However, here's the defense management laid out, and I think it's credible. That uptick is primarily driven by just two specific relationships.
Oh, just two.
Two in-market multifamily loans. So this isn't a broad-based deterioration across the portfolio.
Yeah.
It's idiosyncratic.
According to management, yes, they were very specific. These are loans held for sale. They expect little or no loss, and they aim to resolve them by the end of the current quarter, so Q1 2026.
Little or no loss is a bold claim when NPLs double.
It is a very bold claim. But look at their reserves. They have an allowance for credit losses, or ACL, of $97.1 million. And more importantly, look at their pre-provision net revenue. They are generating so much cash from that 4% margin that they can afford to absorb a hit if they have to.
So the narrative is, yes, we have a couple of bad loans, but we're making so much money it doesn't matter, and we're going to fix them in 90 days.
That is the pitch. And frankly, with a tangible book value that is growing and a return on tangible common equity, or OTCE, targeting 16% by the end of the year, the market is buying that narrative.
Just to clarify ROTCE for the audience, that's basically the return on the shareholder's actual cash investment, stripped of goodwill. 16% is high.
For a bank of this size, it puts them in the top tier of profitability. If you can generate a 16% return on equity in a falling rate environment with manageable credit costs, you deserve a premium valuation multiple.
Most banks are fighting to get to 12.
Which brings us to the investor context. If you're listening to this, you might be wondering, okay, I missed the pop this morning. Is it too late?
Well, let's look at the relative strength. Over the last year, MCB is up about 30%. The KRE, the regional bank index, is up about 9%. MCB is winning the rates plus credit game.
They are separating themselves from the pack. They're decoupling.
They are. The market is starting to view them not just as a generic regional bank, but as a growth compounder. And there's a catalyst on the calendar to watch.
March 3rd, 2026, Investor Day.
Right at their New York headquarters. This is likely where they're going to unveil the long-term benefits of that digital transformation we joked about and give more detail on the Florida opportunity.
Okay.
If they walk into that meeting with the NPLs resolved and the digital platform live, that could be a significant re-rating event.
It feels like the sentiment has shifted from show me to we believe you. The consensus is sitting at a moderate buy, but the price action today tells you the real story. The market is buying the growth story over the credit risk story.
Agreed. The burden of proof was on them to show they could handle the credit wobble, and they did it while printing a huge earnings beat.
Okay, we've covered the number, the strategy, and the risks. Now let's get into the section that our legal team loves to hate.
It is time for the This Is Not Financial Advice segment.
Reminder to everyone listening, we are two voices in your headphones. We are not your financial advisors. Do not trade on this. We are just brainstorming wild ideas like we're sitting at a hedge fund idea dinner. What do you have for me?
I'm looking at this geographic setup, and I am seeing an arbitrage opportunity. I call this the snowbird spread.
The snowbird spread. I like it. Break it down.
The thesis is simple. MCB is executing a geographic arbitrage. They're taking low-cost deposits from sticky relationships in New York. Think municipalities, property managers who can't move their money easily.
And they're lending that money into the high-demand, high-yield Florida market, taking cash from the frozen north and lending it in the sunny south.
Exactly. So the trade is you go long MCB to capture that 4.1% NIM expansion, but you pair it with a short on a generic regional bank that is already in Florida.
Why short the Florida bank?
Because the local Florida banks don't have the New York deposit base. They're funding their loans with expensive wholesale funding or fighting for hot money in a high-rate environment. Their margins are getting crushed while MCDs are expanding.
Right.
You are longing the funding advantage and shorting the funding disadvantage.
That is spicy. You're betting on the efficiency of the liability side. I have a kicker for you.
Let's hear it.
I call it the President's Day pivot.
Cool.
We know the digital transformation goes live President's Day weekend in mid-February. We know Investor Day is March 3rd.
Right. The timeline is tight.
The narrative right now is regional bank.
Huh?
I think after March 3rd, the narrative shifts to tech-enabled growth platform. You buy calls expiring in March to capture the pop from that Investor Day. You are betting that Mark DeFazio gets on stage, shows off the new tech, announces the bad loans are gone, and the multiple expands from a bank multiple to a growth multiple.
That is aggressive.
Yeah.
You're playing the event path. If the tech rollout has a glitch, those calls go to zero.
High risk, high reward. That's why it's the not financial advice segment.
Yeah,
but
sure.
The setup is there. You have a fundamental tailwind meeting a specific catalyst event.
It is a compelling setup, I will give you that. The snowbird spread with a President's Day kicker.
There you have it. Look, to wrap this up, Metropolitan Bank Holding Corp just delivered a monster quarter. Earnings per share of $2.77. They prove they can grow deposits even as rates shift. They gave confident guidance for 2026, targeting a 16% return on tangible common equity.
And they are doing it while expanding into Florida and overhauling their tech stack. It's a very busy, very productive time for this management team.
The one thing you need to watch, those MPLs.
Absolutely. The key to this stock holding $90 and moving higher is the resolution of those multifamily loans in Q1. If they clear those without loss, the ceiling lifts significantly. If they linger, the doubts will creep back in.
We will be watching Q1 very closely. That is it for this deep dive into MCB. Thanks for listening to Talk Tickers. We will see you next sprint. See you then.